Auditing share capital. The audit objectives. To ensure all the share capital is properly classified and disclosed and the company's statutory record is properly maintained. The audit procedures. Share capital are comprises of issued and fully paid ordinary shares and preferred shares. Audit procedures begins with collecting all the schedule of the activities. The beginning balance has to be agreed to the prior year's working paper and the ending balance is agreed to the general ledger. All the movement during the year will be the major concern. The audit procedures for existence, occurrence and completeness. To ensure the authorized share capital of the company is in agreement with the M&A and the share registrar, cast all the shares outstanding in the share register and valid share capital transaction must be properly approved. If shares issued at a premium, it has to be credited to the share premium account. Check dividend payment with documentary evidence, calculate the tax on dividend. Therefore the auditor can verify the transaction recorded, determine that the shareholders' records are properly maintained, verify the total number of shares outstanding and send confirmation to the registrar. Auditing procedures for valuation and allocation. When share capital issue for cash, assessment of valuation is straightforward. If issue on premium, the difference between price and par will be credited to share premium account. Valuation is more complex when share capital issue under bonus issue. Audit procedures for presentation and disclosure. An entity shall disclose the following for each class of share capital: the number of shares authorized, number of shares issued and fully paid, issued but not fully paid and par value per share. Auditing reserves and retained profit. The audit objectives are to ensure all movements on reserves are properly accounted for, all reserves are properly classified and disclosed and the amount reported are in agreement with accounting record. Audit procedures. First examine the opening balance with the previous year audited financial statement. Then compare the year-ended figure per management financial to the general ledger and identify the movement and examine the fairness of the movement. Auditing investment. Investment may be valued at cost or market value. Current investment are held for trading or are intended to be held for more than 1 year. The audit objectives are to consider confirmation of ownership of the investment and client has legal title. Investment are correctly stated at cost or at appropriation valuation, profit or losses on disposal are correctly accounted for, all investment and investment income has been accounted, investment and investment income are properly classified, described and disclosed. Audit procedures. Prepare the analysis of investment which shows opening balance, closing balance and movement during the year and check the agreed last year figure, general ledger and the figure carried to the financial statement. Existence and occurrence. Inspect certificate of securities. Examine contract notes. Rights and obligation. Verify purchase and sales. Determine whether any securities have been pledged. Completeness. Consider cut-off as it concerned with the purchases and sales of securities by examining the transactions and do analytical procedures. Valuation and allocation. Determine basis for valuing the investment and ensure there is no diminution value. If there's any, the carrying value of investment must be written down. Presentation and disclosure. Determine all the disclosures required have been complied for investment. Auditing investment related to income are normally done at the same time of auditing investment and the audit procedures are usually recorded on the same audit working papers. The audit procedures. Review basis of recognizing income, obtain schedule from client. Check that all income have been received, review income accounts for any unusual entries, check cash receipt and related evidence and recalculate the gain or loss on investment disposal. Auditing intangibles. Intangibles asset with definite useful life will be amortized and those with indefinite useful life should not be amortized. Audit objectives are to determine the asset exist and are owned by client. Amount stated at cost are correctly calculated, all intangibles asset are recorded, disposal are accounted correctly, any asset affected by permanent impairment have been written down and intangibles asset and related expenses are properly classified, disclosed and recorded. Audit procedures. Prepare analysis of intangibles shows opening balance and closing balance, check the agree last year figure, general ledger and the figure carried to the financial statement, examine supporting documents for evidence and review the reasonableness and consistency of application of the method of amortization. Post-balance sheet event. Auditor should consider the effect of subsequent event on the financial statement. The term of subsequent event refers to both The event that occur after period end and the date of auditor's report and the facts that discovered after the auditor's report date. Events that are both favorable and unfavorable that occur between the balance sheet date and when the financial statement are authorized for issue. Subsequent event review. The management has the responsibility of establishing the policies and procedures to account and identify the subsequent events. The auditor should review the management's procedure to identify any subsequent events and perform specific audit procedures designed to identify those events. For any material subsequent event found, the auditor must determine on whether they have been properly accounted for or disclosed in the financial statement. Subsequent time dimension. Period 1 is from year-end during the fieldwork but before signing audit report. The auditor is responsible to perform procedure to identify and evaluate whether the subsequent event occur a material or not. If there is, the auditor need to make necessary adjustment. Period 2 is from signing date to delivery of financial statement. The auditor have no responsible to perform any audit procedure. The management is responsible to inform the auditor of facts that may affect the financial statement. If the auditor find that the fact is material, he needs to decide whether the financial statement needs an amendment and discuss further with the management. If management amend the financial statement, the auditor need to perform additional audit procedures. Period 3 is after delivery the report. The auditor have no responsible in performing audit procedure. Subsequent events. Adjusting events. These events affect the financial position and the financial statement on balance sheet and these events need to be accounted for. Non-adjusting events. This is the condition that does not exist in the balance sheet date but exists subsequent to that date. If it is material, it need to be disclosed in the notes to the account. Subsequent event audit procedures. Review that management procedures and policies has been established to ensure the subsequent event are identified. Read on the minutes of meeting. Review the cash flow forecast, budget and other management report. Inquiring to the lawyers. Discuss with the management on new capital commitment and borrowings, sales asset, issue new shares or debentures and any damage of asset due to fire or flood. Discuss on the contingent liability and capital commitment.
Now, we move to contingency and commitment. What is a contingencies? It refers to a possible liabilities that arise from the past events and the existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. There might be a risk that they will not be completely and properly disclosed. A provision for the contingent liability is recognized as a liability in the balance sheet while a contingent liability will not be recognized. FRS 137 indicates that contingent liability is not recognized as a liability because its existence will be confirmed only by the occurrence or non-occurrence of future uncertain events. Any material contingent liability should be disclosed in the FS. For example, a corporate guarantee is given to lenders for loans to another party. The audit procedure to identify contingent liability are as follow. Read the minutes of meetings and inquiries of management. Review contracts, loan agreements and leases. Review income tax liability and tax return. Inspect other documents for possible guarantees. Now we move to commitments. What is commitment? It is an agreement to commit the entity to a set of fixed conditions in the future regardless of what happens to profit or to the economy and have to be disclosed in the notes to financial statement. Entity will enter into long-term contractual commitment to acquire capital assets such as plant and machinery. Knowledge on contingencies and commitment is important to the users of financial statement because they represent the condition of potentially material amounts of resources that may be utilized during the period and will affect the future cash flows available to users. Going concern concept. It refers to important assumption underlying the preparation of financial statement. Auditors are required to assess the risk of going concern problems at the planning stage and during final review. An entity is assumed to be able to continue as going concern at least 12 months. Assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal course of the business. Going concern consideration. The indication that the auditor needs to be alert for the going concern problems. 1. Operating indications. For example, loss of major market, shortage of supplies and loss of management personnel. 2. Financial indications. For example, net liabilities, fail to pay creditors when falling due, inability to obtain financing and difficult on complying with the term of an agreement. 3. Other indications. For example, pending legal proceedings against the entity. Auditor responsibility is to 1. Consider the use of going concern assumption in the preparation of the financial statement. 2. Alert when there are material uncertainties on the ability of the entity to continue as going concern that must be disclosed in the FS. Step to be taken by auditors. 1. Evaluate whether audit procedure done during the audit provide any indications of events which cause substantial doubt. 2. If there is any substantial doubt, information about the management's plan to mitigate the going concern problem should be obtained by an auditor. 3. If the auditor concludes that there is substantial doubt, the auditor has to consider the adequacy of the disclosure with respect to uncertainty and include an explanatory paragraph in the audit report. Once appropriate evidence has been accumulated, an auditor must decide whether the question about going concern has been satisfactorily resolved and consider the appropriate report. Going concern assumption considered by auditors is 1. Totally appropriate and resolved. No modification of report. 2. Appropriate because of mitigating factors. Mitigating factors have to be disclosed in the notes to financial statement. Auditor report is an unqualified report with the emphasis of matter. If no disclosure on mitigating factors, auditor report is a qualified opinion if not so material and adverse opinion if material. 3. Inappropriate. This happens when the result of the going concern is inappropriate. Auditor report is a disqualified opinion if not so material and adverse opinion if material. 4. Not resolve. Auditor should adequately disclose about the uncertainty in the financial statement. Auditor report is a disqualified opinion if not so material and disclaimer opinion if material.
Now, we move on to auditing for accounting estimates, including fair value accounting estimate and related disclosure. The objective of this audit is obtain sufficient appropriate audit evidence whether accounting estimates, including fair value accounting estimates, are reasonable and related disclosure in the FS are adequate in the context of the applicable financial reporting framework. What is accounting estimates? It is the approximate of monetary amount if there is no precise means of measurement. It is used for an amount which is measured at fair value where there is estimation uncertainty. While estimation uncertainty is the susceptibility of an accounting estimate and related disclosure to an inherent lack of precision in its measurement. Management bias refers to the lack of neutrality in the preparation of information. When is it required? 1. Risk assessment procedure and related activities. 2. Identify and assess risk of material misstatement. 3. Responses to assessed risk of material misstatement. 4. Further substantive procedure to respond to significant risk. 5. Evaluate reasonableness of accounting estimates and determine misstatement. 6. Disclosure related to accounting estimate. 7. Indicators of possible management bias. 8. Written representations. 9. Documentation. What we should know. We should know that when there is a low estimation uncertainty, it may lower the risks of material misstatement. For instance, accounting estimates that are frequently made and updated as they relate to routine transaction, or fair value accounting estimate where the model used to measure is well known or generally accepted, provided that the assumption or inputs to the model is observable. Examples of accounting estimates include allowance for doubtful accounts, warranty obligation, repairs, depreciation method or asset useful life, outcome of long-term contract. While examples for fair value accounting estimates: complex financial instruments, which are not traded in an active and open market, share-based payment, property or equipment held for disposal, certain assets or liabilities acquired in a business combination, including goodwill and intangible assets. All in all, in this subtopic, the management are the one who is responsible to prepare the accounting estimates in the FS. The management judgment is normally based on its knowledge and experience about past and current events and its assumptions about conditions it expects to exist and courses of action it expects to take. Therefore, the auditor is responsible for evaluating the reasonableness of accounting estimates made by management in the context of the FS as a whole. Accordingly, when planning and performing procedures to evaluate accounting estimates, the auditor should consider, with an attitude of professional skepticism.
Now we move to related party. The objectives of the auditor are to obtain an understanding of related party relationship and transaction sufficient to be able to recognize fraud risk factors, which is related to the parties, that are relevant to the identification and assessment of the risk of material misstatement due to fraud, and to conclude, based on audit evidence obtained, whether FS are affected by those relationship and transaction, so that it can achieve fair presentation, for fair presentation frameworks, and are not misleading, for compliance frameworks. Related party can be referred as when one party has the ability to control the other party or exercise significant influence over the other party in making financial decisions. It can also be referred as the relationship between a parent and its subsidiaries when the parent has a control and influence over the subsidiaries, which is known as intercompany relationship. Based on the situation 1. Parent and subsidiary are RP. Parent and associate are RP. Subsidiary and associate are RP. While in situation 2. JV, Co and Co are RP. JV, Co and Co B are RP. Co. A and Company B are not RP. There is no related parties between a parent or a company towards supplier, customer, bank, and government, because we do not have control or significant influence towards them. Common ways to identify the related parties are from the inquiry of management and examination of shareholders listing. What is related party transaction? It can be referred as any transaction between client and a related party. For instance, sales and purchase between parent and subsidiaries. As material transaction must be disclosed, it is important that all the related parties be identified and included in permanent file early in the engagement. Hence, finding undisclosed related party transactions is enhanced. Transaction with related parties are important to auditors because under MASB 8, related party disclosure requires that it should be disclosed in the FS if they are material. The transaction is not an arm's length transaction, hence, there will be risk that the amount will not be the same if the transaction had been with an independent third party. That disclosure requirement includes nature of related party relationship, description of transaction, amounts to from and to related party transactions.
Management and auditor's responsibility. Management representation letter as audit evidence. Implications of contradictory evidence. According to ISA 580, auditor need to get relevant representation from management. It may be oral and then documented.
Management representation letter. Management letter to auditor to certify that all information has been disclosed accordingly in financial statements and will be dated same day as financial statements are validated. Significant purpose of management letter. A. Management acknowledgement for its financial statement responsibility. B. Management representation as audit evidence. C. To conform the oral representation, documented oral presentation. If management refused to sign the letter. Auditor to establish a scope constraint, issue modified report or disclaim, if financial statements are material and pervasive. Audit report. Audit report is the final stage in the entire audit process. It is a written audit findings to the shareholders. It also may be read by the others such as bankers, creditors and other parties who use the information in financial statement. Basic elements of an auditor's report includes 1. Report title. 2. Addressee. 3. Introductory paragraph. 4. Scope paragraph. 5. Opinion paragraph. 6. Name and signature of auditor. 7. Date of the report. 8. Name and address of the audit firm. 1. Report title. To make it clear to the user that the financial statement has been audited. Also to distinguish it from other reports in annual report. 2. Addressee. Under the Companies Act, the report must be addressed to the members or shareholders of the company. 3. Introductory paragraph. To state that an audit was conducted on the financial statements and the period covered. 4. Scope paragraph. Description of the auditor's scope of works and the general nature of audit procedures to obtain a. Reasonable assurance that the financial statement is free of material misstatement. b. Statement as to the adequacy of the procedures. 5. Opinion paragraph. Auditor conclusion based on the results of the audit and professional judgment, whether the financial statements give true and fair view. 6. Name and signature of auditor. The name and signature is an acknowledgement of responsibilities. 7. Date of the report. Date on which auditor has completed all significant audit procedures. It should not be earlier than the date on which the financial statements are signed or approved by director. Normally at least 14 days before AGM. 8. Name and address of the audit firm. Name and address of the firm should be identified, usually the city where the auditors maintain the office. Types of auditors report. 1. Unmodified or unqualified auditors report. 2. Modified or qualified auditors report. Unmodified or unqualified auditors report have two types of report which are 1. Standard unqualified opinion. 2. Unqualified opinion with emphasis of a matter, standard unqualified opinion. Unqualified opinion is issued when following conditions have been met. Auditor have obtained all the information and explanation. Financial statement prepared in accordance with the accounting standards, relevant regulations and statutory requirements. Auditor concludes that the financial statements are free from material misstatement. There are no circumstances requiring for additional explanatory paragraph, emphasis of a matter report. Complete audit took place with satisfactory result and financial statements present a true and fair view, but the auditor believed that it is important to provide additional information. For example, emphasis of a matter, substantial doubt about going concern or other uncertainty. Modified or qualified auditor's report. Issued when auditor unable to obtain sufficient appropriate audit evidence. Other than that, auditor is unable to obtain the information or explanations that are necessary for the purpose of audit. Besides, financial statements are materially misstated whereby the financial statement does not comply with approved accounting standards and auditor disagrees with the management regarding the selection of accounting policy and adequacy of disclosures. When an auditor is unable to issue unqualified report either due to scope limitations or disagreement, he may issue qualified auditor's report with one of the following three types of report. A. Qualified opinion with except for. B. Disclaimer opinion. C. Adverse opinion. A. Qualified opinion with except for. Issued either due to limitation on scope or disagreement with management. Auditor is of the opinion that the overall financial statements give a true and fair view. Effect is not so material and pervasive that it not requires an adverse or a disclaimer opinion. B. Disclaimer opinion. Issued due to limitation on scope. Auditor unable to obtain sufficient appropriate audit evidence to form on the overall financial statement. Auditor unable to form an opinion. Effect of uncertainty is so material and pervasive. C. Adverse opinion. Issued due to disagreement with management. Auditor believes the overall financial statement so materially misstated and do not present a true and fair view. Qualified opinion should be expressed when the effect of a disagreement is so material and pervasive. Types of modified auditor's report. Unable to obtain sufficient appropriate audit evidence or limitation of scope or uncertainty. 1. If the effect is material, then use except for. 2. If the effect is so material and pervasive, then use disclaimer. Disagreement with management or financial statements are materially misstated. 1. If the effect is material, use except for. 2. If the effect is so material and pervasive, use adverse.
Let's continue with new ISA 701, Communicating Key Audit Matters in the Independent Auditor's Report. In this presentation we will highlight the key aspect of the new ISA 701 that deals with the auditor's responsibility to communicate key audit matters in the Independent Auditor's Report. Key audit matters are those matters that in the auditor's professional judgment were of most significance. The communication of key audit matters in the auditor's report is intended for the auditor to highlight information about matters of most significance in the audit. There are 3 requirements for key audit matters. First, determining key audit matters. Next, communicating key audit matters. And lastly, documentation of key audit matters. Determining key audit matters. The auditor shall determine which of the matters communicated with those charged with governance are the key audit matters. In making this determination, the auditor shall take into account areas of significant auditor attention in performing the audit, including areas identified as significant risks in accordance with or involving significant auditor judgment. Areas in which the auditor encountered significant difficulty during the audit, including with respect to obtaining sufficient appropriate audit evidence. Circumstances that required significant modification of the auditor's planned approach to the audit, including as a result of the identification of a significant deficiency in internal control. Communicating key audit matters. The auditor shall communicate the key audit matters determined in a separate section of the auditor's report under the heading Key Audit Matters. The auditor's report shall state that key audit matters are those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period. Key audit matters are selected from matters communicated with those charged with governance, but are not intended to represent all matters that were discussed with them. The auditor's procedures relating to these matters were designed in the context of the audit of the financial statements as a whole, and the auditor's opinion on the financial statements is not modified with respect to any of the key audit matters, and the auditor does not express an opinion on these individual matters. The auditor shall describe each key audit matter in the Key Audit Matters section using an appropriate subheading. The description of each key audit matter shall include an explanation of why the auditor considered the matter to be one of most significance in the audit and, to the extent the auditor considers it necessary as part of this explanation, its effect on the audit, and a reference to the related disclosures in the financial statements. Interaction between descriptions of key audit matters and other elements required to be included in the auditor's report. A matter giving rise to a qualified or adverse opinion or the existence of a material uncertainty related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern is by its nature a key audit matter. However, the auditor shall report on these matters not describe these matters in the Key Audit Matters section of the auditor's report, and include a reference to the basis for qualified or adverse opinion or the going concern sections. Communication with those charged with governance. The auditor shall communicate with those charged with governance those matters the auditor has determined are the key audit matters to be included in the auditor's report. Circumstances in which the auditor has determined there are no key audit matters. If the auditor determines that there are no key audit matters to communicate in the auditor's report, the auditor shall discuss this conclusion with the engagement quality control reviewer, for those engagements where one has been appointed. Communicate this conclusion with those charged with governance, and explain in the auditor's report that this section of the auditor's report is intended to describe the matters communicated with those charged with governance that the auditor has determined, in the auditor's professional judgment, were of most significance in the audit of the financial statements, and the auditor has determined that there are no matters to report. Documentation. The auditor shall document the matters that will be communicated as key audit matters, and the significant professional judgments made in reaching this determination. This includes, where applicable, the rationale for the auditor's determination that there are no key audit matters to communicate in the auditor's report,